The Johannesburg and New York listed AngloGold Ashanti is taking steps to reduce its debt exposure by $1 billion in 6 steps that will put its 5 South African operations into 3 frameworks and, if required, will involve the sale of some of its assets or the bringing together of joint venture partners.
We're happy to look at a sale or JV of an operating asset if it's needed. Here, what we have not done is specified any particular asset. We want to keep our options open. What we don't want to do is to box ourselves into one particular asset. At this stage, we're looking at a range of options in this regard in terms of self-help measures. Despite all the noise that took place in the market in the third quarter, our safety performance has been very good. The production performance and the operations are firing on all cylinders. We have still shown our commitment towards cost. We have looking at proactively managing our balance sheet. We're under no pressure to do so within the short term. We've given ourselves a target to get the debt reduction down over the medium term by about $1 billion, but that's largely through self-help measures. Our aspirational medium-term target, which we feel appropriate as a prudent management team, which is to deleverage around $1 billion over the medium term defined as up to 3 years. And we are cognizant of shareholders' feedback in that regard regarding dilution. So what we have prioritized is a range of self-help measures. And in addition to that, we may also consider a sale or joint venture of an operating asset for value. And people ask us, what do you mean for value? It basically means the shop isn't open for bargain hunters. So in terms of prioritizing self-help measures, in the South African operations, we are looking at reducing the footprint from 5 mines and 2 surface operations into 3 entities. To capture operating synergies, you can take out common infrastructure, duplicated layers of management. Looking at the international operations, we are looking at more efficiencies and working capital reduction. What we have achieved to date, certainly in all the mines, has been how can we do more with less. All-in sustaining costs for the international operations have dropped 13% to $973 an ounce, notably in continental Africa by 20%. So now, having touched the $975 an ounce mark, Ron wants to test the $900 an ounce mark.
I just wanted to clarify, you spoke about Ron wanting to test the $900 an ounce.
That's purely for outside of South Africa. The South African all-in sustaining cost structure is higher. And what you can't do is apply the same methodology which we are using in the international operations. This has to be more fundamental. By shrinking the footprint, removing redundant infrastructures, pulling up efficiencies, etc.
And what would be the target dollars per ounce?
We don't want to put that out in the public domain at this stage.
Annual production is expected to be between 4.35 to 4.45 million ounces, and that was despite the impact of the earthquake and the reduction in Obuasi's production. All-in sustaining costs remains unchanged at our previous guidance of $1,025 to $1,075 per ounce. Capex guidance has been reduced then to $1.25 billion to $1.3 billion, which does reflect the saving of about $125 million, largely related to lower Obuasi capex and some further rationalization of capex across the group.
That was AngloGold Ashanti CEO Venkat and new CFO Christine Roman outlining the tightening shape of Africa's largest gold mining company.